Hello everyone, thanks for tuning in once again. This is another in our income series of videos, the search for income, the hunt for income, what income investors need to be considering in order to meet their objectives. And today I'm absolutely delighted to be able to talk to Dan Carter, manager of the Jupiter Japan Income Fund. Dan, great to see you once again. How's everything? You're in the office. Wow.
I am in the office. Yeah. Well, thanks very much for the invitation. I really appreciate it. It's good to come on and do this. Yeah, I'm all right. I mean, despite everything that's going on around us, yeah. I mean, things feel exciting, right? I mean, there's stuff going on in the market. There's stuff going on for the portfolio. So things are good on that score. But yeah, we are going to be working from home a lot more. I think probably this is going to be my last day in the office for at least a few weeks, depending on what Boris says.
Absolutely. Lockdown version 2.0. Let's see how this pans out. So first of all, Japan, it's a market that we don't really hear much of within the UK. How's it fared during the pandemic?
I mean, it depends how you look at it, right? So I don't want to start by sitting on the fence too much, but it does depend how you look at it. In one way, it's fared unbelievably well. So if you look at Japan from a sort of public health perspective, and I know we're talking markets here, so I'll get into that in a second. But if you look at it from a public health perspective, Japan is absolutely where you've wanted to be, right? So I just actually looked up the number of confirmed COVID deaths that Japan's had through the pandemic. It's just over 1,700, right? Wow. That's in total, right? And this is for a country that has 25% of its people are over 65 years of age, 20% of its people are over 70 years of age. Exactly the kind of people that you might expect to be hit really hard by this kind of infection. And we can talk about it later on if you want sort of detail on some of the conjecture as to why they've done so well. But the bottom line is they have done unbelievably well from a public health perspective. So they've had a great pandemic, if such a thing is possible, from a public health perspective, right? I don't want to be, I don't want to minimize the 1,700 people who have been killed, of course, but relative to other countries, unbelievably well. But what about the market? How's that translated to the market? Well, I don't think it can have hurt the market, the fact that they've done sort of relatively well. But if you look at Japan, again, it depends what you compare it to, right? If you compare Japan to the UK, Japan's been an amazing market to be in, primarily because the UK has been such a shocking market to be in. If you compare it to other big industrial countries like Germany, it's done better than that, right? So you'll see Topix, which is the big index for Japan, has done better than the DAX. But the one comparator that pretty much all developed markets look bad next to is the US. Yeah. So Japan's done all right. I mean, given everything that's happened this year, I think you might have expected it to have been worse than, down a few percent, which is where we are on a year-to-date basis. But the US is sort of flat or marginally up, right? So something has been going on funny there. I think that's more of a US issue. I think it's more about the composition of the US. And, the fact that the FANGs are so big and all of the rest of it, that sort of growthy stuff has really pushed the US market relative to Japan, which is a little bit more smokestack, does have a little bit more of a sort of value characteristic about it. And again, we can talk about that in detail in a bit if you want. But that has meant that in that sort of bifurcation that we've seen in the market on a year-to-date basis, Japan has sort of done a little bit less well than you might have expected. But as I said, because it's dealt with the virus kind of so well, it certainly hasn't been hammered in the way that the UK or some other markets has.
Yeah. It seems to me that Japan, as a region for investors, is overlooked, certainly for income investors. Why should they take notice now?
So I think there's a few things. So Japan, you're right. I mean, Japan is not the obvious place to go for income. And I'll be honest, if you want to absolutely maximize your income, probably you don't need an enormous Japan allocation, right? You probably don't need to. But if you want to have a pretty sensible global allocation, you can definitely do so and still generate, reasonable income in Japan. So again, if you compare, and we are going to be comparing some of the best markets with some of the worst markets, if you compare the UK market to the Japanese market, and I'll come back to an important part of that comparison in a second, but if you do compare those, then the Japanese market is not going to be as yieldy as the UK market. However, compared to the US market, then it is pretty yieldy, right? And if you go back 10 or 15 years, that wouldn't have been the case, right? You know, the Japanese market would have been the least yieldy major developed market out there. And that's no longer the case, right? It's now sort of in the mix, right? So it's not going to destroy your overall global yield seeking portfolio, income seeking portfolio. So that's one thing. And then there are a couple of other things going on, and they're sort of two sides of the same coin, really. One is the Japanese market, so the Japanese companies that make up that market are really, really financially conservatively managed, right? And have been for a very, very long time. So you've got Japanese companies, on average, excluding financials, about 55% of them are trading with net cash, right? So they've got more cash on their balance sheets than they do debt. They're hugely well capitalized balance sheets, very, very strong financially. So that's one thing. Obviously, that's been because they've been saving money rather than spending it, right? They've been putting the money, keeping it on deposit, keeping it on their balance sheet rather than giving it back to shareholders. That can be a negative thing, right? They've been a bit stingy with the payouts. But the good thing about that is that in a drawdown like this, where profits go down and the tide goes out, Japanese companies have got a pretty low payout ratio, right? The proportion of their profits that they're paying out in dividends going into this crisis was about a third, maybe a little bit more, 35, 36%, something like that, which means that if profits go down a lot, they're not forced to cut their divvies. And I said before, I was going to compare a bit to the UK market. UK looks like it's high yielding, but of course you're seeing massive divvy cuts left, right, and center. Whereas in Japan, because you've got those payout ratios that are relatively stingy already, and you've got balance sheets that are super strong, basically Japanese companies don't need to cut their divvies. So there are a couple of things that I think people need to think about Japan in the context of. One is, don't just totally forget about it. Presume that it's really, really low yielding, because it isn't anymore. It's all right. And the other thing is that sustainability, rather than super high year one divvy yield, is what you should be buying Japan for.
Mm-hmm. Looking forward, if we possibly can, and then focusing upon your fund, the Japan Jupiter Japan Income Fund, where do you see markets moving, and how are you positioning the portfolio?
Yeah, okay. So it's a great and very difficult question, right? I mean, I think the most important characteristic of market moves over the last several months and probably the last few years has been that bifurcation between value and growth, right? So the question is, for how long does that go on? And we've had a number of sort of trading sessions in the past sort of few weeks where we've seen, big gulps where those two lines that have diverged have suddenly sort of gapped closer together. I think probably you do see a few more of those, right? So I think that that's going to be a characteristic. I'm not saying that from here on, this is going to be a value market and all of those, value managers that have had, terrible time on a year-to-date basis, they're going to make it all back. That's not what I'm claiming at all. And neither am I claiming that having a growth premium in what you're doing is necessarily a bad idea. But I do think that those two lines probably cease to continue to expand, right? So I think that maybe looking at some of those sectors, not the real dead sectors, we're never going to look at those anyway, but maybe some of those slightly more industrial sectors, maybe some of those businesses that are a little bit heavier in assets, a little bit less asset light, a little bit less internet driven, etc. Actually, that might be where there is some attention in the coming several months, purely because it's been ignored so much.
Yeah.
And if you look at how these businesses are performing, actually they're performing pretty well, right? So if we go back to the last quarter, and I know we don't really deal in quarters, but sometimes you get a good heads up, right? If you go to the last quarter of earnings announcements for Japan, we saw both manufacturing and non-manufacturing beat expectations, right? So it was pretty good across the board. Those expectations were pretty low because it was the worst quarter for COVID, right? It was that sort of spring summer quarter. But the beat was biggest actually in the manufacturing rather than the services or non-manufacturing. That is the asset heavy stuff. That's the smokestacky sort of stuff. It's the more industrial sort of stuff. And I think that just tells you that expectations there are really, really minimal. So I think we do need to think a little bit about market leadership potentially rotating a little bit.
Okay. And have you made any changes to the portfolio? Is this something that you've already got positions in? What's the situation there?
Yeah, so the way it works with our portfolio is that we try and be true to style all the time. And what that means is that we've got two really significant premia that we want to have in the portfolio at any one time, right? We want to have that premium yield. So this is the Jupiter Japan Income Fund,
Yeah.
but we don't want to be out and out yield seeking. We don't want to be at the bottom of the barrel for, you know, the valuation spectrum. You know, we want something that's going to be coming through for these companies, creating a catalyst so that value can realize and we can make some money for our clients, right? So we also want a premium of earnings growth as well. So everything that I've just said in terms of that sort of bifurcation of those two styles, you know, we totally see within our fund. So what we've seen within our fund on a year-to-date basis is that, you know, half of the portfolio has done really, really well. Half the portfolio has done much less well, and you've had a stretching out there. So what we've had to do, because that, you know, obviously that portion of the portfolio that's done well has become bigger in size.
Yeah.
The portion of the portfolio that's done poorly has become smaller in size. So you end up getting dragged around, and you're not necessarily getting these dual premia in the same way that you want. So the trading that we've done has not been sort of massively opportunistic, right? We're not taking a call on, actually, we think this is going to happen, so we're going to skew the portfolio one way or the other, because to be honest, our timing on that is unlikely to be perfect. But what we do is we try and right the ship, basically. So there are definitely some sectors and some businesses that we've increased our exposure to. So we've increased our exposure a little bit to construction. There are one or two construction companies within the portfolio that we think are, you know, are really quite cheap, very high yield. Often they've got stock specific or company specific reasons that we like them. You know, an improvement in shareholder payouts because of some activism, etc. That kind of stuff, some special situation stuff going on, just to back up the idea. And for that, to fund it, we have trimmed back some of those, you know, some of those gilt-edged foreign favorite growth ideas. So we've been moderating some of those. We've got to be careful not to sell too much growth, though.
Yeah.
You know, you don't want to sell all of your winners, right? So what we've been trying to do is sort of recycle within it. Right. So, you know, selling expensive growth to buy cheaper growth basically is something that we've been trying to do.
Fantastic. Well, we'll see what again this pandemic throws out. Because it's not just the UK it's affecting the globe, and as you said, Japan's you know, faced this up very, very well, and we'll see how that continues. As ever, Dan, it's an absolute pleasure to talk to you. You stay safe, I'm sure you will, and I'm sure we'll catch up soon. Cheers.
Thanks a lot. Appreciate it.